All right, let's try this again. If you can hear me, I'm looking for a notification on Twitter. Just send me a tweet 5 by 5. That means you guys can hear me. The volume's good and you can see my charts. Once I get confirmation, I will begin. Okay, thank you for giving me a confirmation you can hear me. All right, let's get over here to this charts and see what we can talk about this morning. All right, here on the left-hand side, I promise I won't keep you here too long today. I have things I have to take care of. I wasn't intending to be here, but we celebrated our son Caleb's birthday yesterday and went a little later than I wanted to. My eyes got tired, so I couldn't sit down and do a review. So this is the easiest way for me to do it, knock it out, so that way it probably will have problems with something. I'll make a mistake in saying something incorrectly or whatever, and it'll just have to be what it is. And if I catch it while I'm doing it, I'll hopefully correct myself at the time. But usually in recorded episodes, I can go and proofread everything before it gets into your hands, and then edit out anything that may happen in the background. I have puppies now, so you may hear them in the background. Okay, so just be mindful of that. All right, so on the left-hand side, we have a daily chart of the S&P, and we've been talking about this market going lower this entire week, and I've been pointing to specific things throughout each review and keeping your focus on the sell side delivery. Yesterday, we smashed through our sell side liquidity objectives for both. And on the left-hand side, at present, these are the levels I'm watching right now. We went below the low here, which is one of the levels we were watching for this week for S&P. We have an order block. The opening price on that, draw that out in time, and you'll see we were only off by one tick, and it was one tick above. So that's always normal delivery. That means if you want to see a specific level traded to and it's above, it'll go to it and through it. But if it's going to be acting as resistance, in other words, if we're in a sell program, we're expecting lower prices, this would be viewed as a traditional area to expect bullishness if the market was underlyingly bullish. But since we've been looking for lower prices, we've been looking for sell side and discount arrays throughout this week. Again, don't take my word for what I'm saying to you here. If this is the first time watching me, go back and look at the recordings I did previous to this one for the next day's market action. These levels can act as inversion levels. Okay, I'm seeing folks call things inverse, like inverse fair value gap. It's inversion. Please don't do it incorrectly, because that's how everything causes confusion, and people start making mentorships and they call things like chooch and change of character and institutional candles, which don't exist. So the opening price here, check the sensitivity of that for today's trading. This imbalance over here, I highlighted that. I want to watch and see, do we have any willingness to get back up into that before trading down into this area over here, which is a small little inefficiency. I think that is a worthwhile discount array to have on your charts. Okay, so you can look at that on the June 8th candles high and the June 12th candles low. The difference in between, there's your fair value gap. It's a discount. It's below the sell side, which we've already delivered to. So I woke up and everything had already panned out through levels that I would have really liked to have mentioned to you beforehand, but that's okay. We've been doing it the entire week. So family first. I got to take care of things, which is why I'm leaving social media in November. I got to get back to being a family man. So we mentioned also the SMT divergence. I want you to go back and look at that and study that over the weekend, how the NASDAQ was unwilling to make the higher high. And then we had a shift in market structure here, just like we did over here on S&P. and that set the stage for a delivery and sell program for the sell side here. And in digging through that, we had all of this price action right here on the NASDAQ, where we had the sell side here on S&P, and here, since we've pierced both of them, this is the only inefficiency that resides below that sell side on the daily time frame. Here, I'm drawing your attention to this old inefficiency because I'm not supply and demand. Okay, for the folks that like to say that's nonsense, because number one, I'm going to cut through candles because I don't need anything to be classified as a fresh zone, because everything I'm looking at in price action is fresh. This baker's got fresh bread every day. So this inefficiency, if we make it through it, I'd like to see it act as resistance at a later time. It may do it today, it may not do it at all, for a few weeks, but it's something I want to have on my charts because it may set the stage for a run into these relative equal lows where there's a larger pool of liquidity. And then we have this buy side imbalance, sell side inefficiency here. So this big up close candle here, that is inefficient. So you want to mark off half of that range between this candle's high on May 25th, this candle's low on May 30th. Put your Fibonacci on that. I'll show you what I mean by that. This is what we're doing. This is how we measure consequent encroachment of gaps or inefficiencies. I don't like the fact that I have that extension on here, so let me take it off. Here's one more opportunity for y'all to see what my settings are on my Fib. I know you guys like to ask that all the time. I try to include it as much as I can. All right, so the 14,351.5. I think that is a nice intermediate term draw on liquidity. Longer term, that's not today's target. Okay, I want you to understand that that is where we could draw to eventually. Below these equal lows, I think that is a favorable level to have on your charts. So I'm going to include it now since I'm talking about it. It's going to snap to it, isn't it? Yeah. I can already hear something. If you just do this ICT, it's easier and faster. I know. I'm sure you probably all have all kinds of tricks about how to do things more quicker, but let the old man do what he has to do, okay? It's free. So that level here, we'll look at this going forward in the future. We'll just leave it as that. Okay. So let's start stripping this down into lower time frames so that we don't keep you here too long. No, ICT, go here, go for hours. We want to hang out. We want to hang out with Pops. All right, so here are those levels seen on the 4-hour chart. You can see how we had an inefficiency in here on the left-hand side, S&P, trade up into that on Thursday. Then we broke lower, and then we had a really nice expansion to the downside. And then moving into small little consolidation, and then digging into and through that sell side liquidity pool. Again, this area down here, I think that is something that should be, and I'm not saying it should be there today, and frankly, my trading is done. Like, I'm not touching anything the rest of the week. I'm not touching anything today, but I wanted to do a review last night, but my personal schedule wouldn't permit it, so I'm trying to do the best I can to keep you up to date. NASDAQ on the right-hand side. Okay, and we had, looks like we have a nice measured move here. Let me see. This price swing down to the fulcrum point right there. Measured moves, nice and easy. Just do something like that. So standard deviation 1, fulcrum point. It means from this high down to that low. If we take out that low, it can move as far as -1 standard deviation. We ended up trading down into the inefficiency on the daily chart. You can see we just touched it there, and it's already showing a willingness to react there, which is nice. We have a fair value gap. This will be seen on the lower time frames. I apologize. I was trying to throw the annotations on the chart beforehand. I was going to do it in a PDF, not a PDF, but a PowerPoint. But it was taking me more time. I was like, yeah, just do it live. Bill O'Reilly style. I'll do it live. So anyway, that level here, we traded into that. Let's go into a hourly chart and see how nice that reaction was. Okay, a small little gap in here. These are all things we talked about on Wednesday. This wick here, half of that's consequent encroachment. We hit that beautifully yesterday, or I'm sorry, on Wednesday afternoon. We broke lower. We'll see this inefficiency on the lower time frame. We're still on an hourly chart now. Trades up into what you'll see later on when you go lower than this time frame is an inefficiency. It trades lower. Shift in market structure. What is this? Fair value gap. But what specifically is it? It's the model 2022. Shift in market structure. Fair value gap in the displacement leg. Trades up into it here. Sells off aggressively. Small consolidation and then digs down into the inefficiency I mentioned that was on the daily chart. We're going to roll over to S&P, drop into a 60-minute chart there. I will talk about euro dollar and dollar index once I get through the indices. I'm not going to be doing, what's it called? I'm thinking of like a DJ, like recommendations or something to that effect. I'm not going to be doing like on-demand Oracle. Okay, I'm not going to be doing oil. I'm not going to be doing Bitcoin and XRP and NFTs and synthetic indices or whatever the hell you're going to ask me to do. It's just what I want to focus on, and I'm getting out of here. So we have an inefficiency here on the hourly chart. You can see we traded up into that at 9 o'clock on Thursday, hung around in that range here. And then in London, we tore off. Bearish order block here, sells off. Sell side was here, it dug into that, and then went down below the sell side. Again, this is seen on the daily chart, so you can. And I don't like this style of doing it like this. This is why I like to do things pre-recorded, so that way I can take my time and go through. So I already feel like I'm breezing through this too fast, and it may not be as appreciated as it normally is, but I'm doing my best to keep up with what's already happened. And those two levels here, that's that old inefficiency on the daily chart. Normally I would have it annotated to show you what it is. Just watch the beginning of the video when we're in the daily chart on S&P, and you'll see that that is those specific levels. This is the high of the inefficiency and the low of the inefficiency. And you can see how we've had respect to that level. Look at the bodies and the wicks in here, respecting that. And then we smash through it here. So watch and see, not only do we trade back to the old low, which is this red level, where sell side would have been defined by the daily chart. It can trade to that, and normal support and resistance guys would say, okay, it's traded there, it's a break and retest, go lower. It could do that, but I would be more interested in this specific level here. And also, more importantly, I would like to see between this dotted or dashed line here, I'd like to see this area here remain open. Okay, because that in itself would encourage me to anticipate lower prices throughout this trading day here, Friday. And then maybe, if things were to get, overzealous on the downside intraday today, we could look for it to try to trade down into this inefficiency here, trading to around 43, 48 and 3/4. What is it called? 43, 49. There you go. It makes it easy. But I'd like to see it stay open. Now, that's not a trade recommendation. This is something that I would like to see when I come back to the charts later on this evening. When I'm done being a dad, being, a family man, not trading. I want to see this area here stay open. If we don't get down to this area down here today, okay, let's play devil's advocate for a moment. If we don't trade to that level here, and this stays open today, I like the idea of a lower opening on Sunday, like a gap lower opening, Sunday's trading, and then reaching into this area Sunday into Monday. That's kind of like what I'm thinking. I don't trade anything anymore and hold into the weekend. I used to do that a lot with Forex. I don't want to do that now because of gap risk. Okay, because all the things that's going on around the world, all it takes is somebody to push the wrong button, and then a lot of things can happen. So unfavorable gap risk now. So we don't want to open ourselves up to that. So here's that shaded area I told you we would see when we drop down to lower time frames. It's that 15-minute sell side imbalance, buy side inefficiency on the right hand side. Okay, it's let me fatten these up a little bit. So it's this down close candle right here. I'm defining it by this candle's high and this candle's low right there. So that's where we traded up into here. And then much like I was saying about this area over here, about staying open, not completely overlapping this portion of this down close candle between the dash line and this candle's low. I want to see that shaded area. I want that to not be traded back up into. Now it could trade up to it here and go into a little bit, but I'd like to see something left there unfilled, meaning much like we just saw here. So this little shaded area here, let me draw it out so you can see it and fully understand what I'm referring to. That low, that high, right there. Notice how we dug into it just a little bit right there with that little wick on that candle. Let me change the color. I apologize. It didn't really stand out too much. To the joker that said fair value gaps have been around since the 1900s. I'm the guy that brought that in the 1900s. It was 1996. Thank you very much. But anyway, this inefficiency here, it stayed open. And then look what happened. We had a lot of movement to the downside. So I'm kind of like wanting to see this very element appear in this section of price action between dash line and this candle's low. Okay. I have to do it because I know some of you are wondering what the hell those lines are, and you probably didn't watch the beginning of the stream. It's this inefficiency on this candle here on the daily chart. Okay, so on the left-hand side, that's the S&P. Pardon me. This very candle is June 12th, 2023. So what I'm showing is the high of this candle, which is June 9th, Friday, June 9th, 2023, that high, and the low of the candle of the Tuesday, June 13th, 2023. So this inefficiency is what I'm highlighting. So I'm viewing this gap, or buy side imbalance, sell side inefficiency, which is a fair value gap. We've already traded down through it. Okay. Now the folks that understand inefficiencies in price, for instance, a la Chris Laurie, when they see this, when it trades down to it here, he's done with it. He's not going to worry about it anymore. That's not the total story. Okay, because there's an algorithm, because it's codified, because I'm sharing how it is and absolutely delivering price. We want to know that these levels do in fact exist, but once they overlap them and it's a redelivery, this area here will be revisited by the algorithm at a later time, and it'll be acting just as you would expect support and resistance to work. When you read a book, you say, okay, here's a high, it went up there and then came lower, so therefore when it trades back up here again, it should act the same way. And when you try to do it, it runs right through it and keeps on going higher. Inefficiencies, fair value gaps, buy side imbalance, sell side inefficiency, sell side imbalance, buy side inefficiency, wicks, the consequent encroachment of them. They are the real support and resistance. Everything you see in books, those things are cherry picked. Those things are always after the fact, just like diagonal support and resistance. If you put 100 people in a room and place them in front of a chart, any time frame, and tell them, look, draw a trend line. You got one chance to draw a trend line, and it has to be the one that price you think will respect in the future. There's going to be a myriad of different trend lines. So which one's right? It's always going to be the one that worked afterwards that they put in their examples or their books. With my fair value gap theory and the way price books, the way it's codified, the way I'm delivering it to, just like I did in the 90s, fingerprints all over this. This is how you see real support and resistance. You'll see real dynamic price delivery and reactions that you would otherwise have never paid any attention. You wouldn't even ever seen it, but it's been here the whole time. It's hiding in plain sight. So anyway, without going into a rant, that's the inefficiency we're looking at, okay? So that way when we see these dashed lines in the lower time frame, back down in the 15-minute time frame, that's these two levels here. That's the high of the inefficiency, and that's the low of the inefficiency. So if we do in fact trade higher, I'd like to see it respect that one, but it can trade up into this little area here and not do too much in terms of, I guess, upsetting what I'm looking for. So let's go into 15. And here's that shaded area here, viewed on the 15-minute time frame. Remember, we were just looking at a 60-minute. That's this area that's shaded out. I want to see that portion stay open, just like we have this little, I guess, an orange colored box. Okay, let me take this range off that we can see it. That, just like this is left open, in other words, this as this movement was going up, we didn't completely trade back to this candle's low. Right there. Man, this thing pisses me off. The separation between this candle's low and this candle's high. We traded just above this candle's high right there on this one, which is institutional order flow entry drill, meaning it's a partial entry of a fair value gap, but doesn't go to halfway. So that's how you define it. Institutional order flow entry drill is any re-entry into an old inefficiency, like this shaded area here. As soon as we enter that, but we do not go to the midpoint, which would be up here. Anything less than that is institutional order flow entry drill. Now I know some of you are like, well, how do I know when to do that when the gaps give? I've already talked about that. Okay, there's no shortcutting it. There's lots of discussions. What the hell? There's a bee here in the room with me. I have no idea how the hell they got in there. It scared me. I feel like Donald Trump when he saw that eagle move around. Gotta make sure I don't lean up against it. I don't want to be stung here listening to me hollering and screaming about it. But anyway, this inefficiency here, that is a breakaway gap. I'd like to see this act in similar fashion. All right. So let's go into a 5-minute chart and wrap this up because I'm already spending way too much time. Much more than I wanted to spend. And we'll do a 5-minute over here. How the hell did that bee get in here? All right, so you can see how we had a really nice delivery off of this. Nice breakaway gap. See, this is a normal redelivery of this inefficiency. It does it here. And then sells off, comes back up into this old inefficiency there, breaks lower, and then we have this one here, institutional order flow entry drill, there. And it does not have this area here completely closed in. Then aggressively it rolls lower. This in here, watch this one this morning. We could go up into that and then maybe dig another deeper low. But I would not be wanting to go long this morning. There's a lot of fever in the market right now that maybe even seek lower prices, and I'm not risking anything today. I'm not trading my live account. I'm even pressing a demo. Okay, you're welcome to do whatever you want to do. I'm not trying to inspire risk today. I've been pretty much bang on all week, and I want to close the week on that high note like that. I will do a review for today's price action, but I can't promise it'll be tonight. So if it's not tonight, it will be tomorrow, sometime before 1 o'clock my local time, and then I'll have a teaching for you on Sunday. So we'll have a lecture teaching, and there you go. I know, I hear you. You said you was going to do euro and dollar. I didn't forget. Just let me get through my rambling. All right, let's go to the daily chart for Dixie. And euro dollar. Hang on one second, I had to flick that beat. I don't usually like to do that to animals. But this bitch just tried to get on me. Hang on one second. He's pissed off at me. All right, euro dollar. The sound's going to sound a little bit different because I stepped out. I'm in my stairway here. See, these are all the things that, maybe not the B, okay, he's an extra today. But he's not being an NPC, he's actually being an intermediate boss I got to contend with. So I got to go back in there and remove him from my office. So let me go over here, traveling through the house. Give me a second. Good old ICT. All right, so here we are. The sound should be a little bit better now. So on the left-hand side, we have the dollar index. I've been counseling you to look for these relative equal highs here. Let me take all this business off. And I wanted you to focus on how we could draw to this level here. And we pierced it yesterday just by a little bit. I'd like to see I'd like to see a little bit more of a meaningful run through this high. And depending upon how we deliver, because this is too shallow of a run above, okay, I want to see it go through it in a little bit more energy, more desire to get through it. And eventually we may in fact want to get back up above this high. I'm not claiming that yet, but I want to see right now just a much more meaningful run above this high here for the dollar index. On the euro dollar, we were looking for lower prices. We have these relative equal lows here mapped out. It's been really sloppy delivery all through this old inefficiency. Here, let me zoom in. I can tell you my OCD is flaring about this presentation because it's not like I would want it to be, but yeah, we're in the trenches right now. So this inefficiency between this candle's low and this candle's high, that's this buy side and balance sell side inefficiency. It's dug down into it here, rallied, and then we work down into it and back and forth. All these daily candles working in that range. Now we're here. So in my mind, I'm expecting this delivery and price right there. Below this, there really isn't any inefficiency at all throughout this on this particular time frame. So what we would be doing is below this, there's no inefficiency over here, but we do have wicks. So you would be dividing your wicks in half, getting consequent encroachment. You would have it on this candle here. I'm not going to draw it out. You can do it for your own charts. But that level there, half of this wick, you'd have that. And the same thing with this one here. Okay. And for order block, it's this down close candle here. You want to highlight the high and the opening price. So if we get below these, going over the next week or so, maybe 2 weeks, that level may be a factor for concern on the discount side. Okay, so we'll use that one there. It's the easiest close level, not have to use the opening price. I prefer the opening price. Why? Why do you like the opening price, ICT, and not just the wick high? Because sometimes you put it on the wick and sometimes you put it on the body. When it's a stubby little wick like that, I'm going to elect to use the body. But if it's a wick, what am I going to do there? I'm going to use the high, and I'm going to use the consequent encroachment, and I'm going to use the opening price. There's 3 specific levels. That's not a zone. That's not a, let's figure out where in this supply and demand zone we're supposed to get a buy or sell signal. That's too ambiguous. I want to see very specific price levels. And those very specific price levels, they're always the same. They're not morphing into something different. They're always static. They're not hiding from you. Your candlestick's the same candlestick I'm looking at. And, well, at least when it comes to futures, because that's a gentleman's market. Forex, depending upon who your liquidity provider is and your broker, daily highs and lows and opening prices and closing prices can be skewed. The prices will be slightly different, even in the same brokerage, like Oanda, or when FXCM used to be in the United States, the scammers. you would be in a different liquidity pool. Some of those prices wouldn't match another account holder in FXCM. So they're constantly debooking you. When you're trading futures, the wonderful thing about that market is everybody sees the same price. So if you really want to be a professional and you really want to graduate into a market that is highly regulated, there's very, very little shenanigans like you would see in Forex. And Forex has improved a lot since 2006 or so. But it still has its own shenanigans. I mean, when you sign up to a brokerage firm with a Forex broker, you basically give them permission to stick it up your ass with no lube. Okay, I mean, that's exactly what you're saying. When you sign up with them, that's exactly what you're saying. Essentially, you're doing that with any type of trading with real money. But you're really bending over and inviting it when you're trading Forex because that liquidity provider has the control. They can open the spread on you within reason, but we don't see that happening to the gross extremes that Forex does. That doesn't occur so much in futures. There is manipulation, but we're all seeing the same high. We're all seeing the same low. There is no discrepancy there, which is why it's a gentleman's market. And my advice to you is eventually, at some point, you're going to want to at least include it in your analysis, and maybe if you should decide to do so, maybe pursue some of your investments in that if it meets your risk parameters and if it's something you want to do. I don't think that Forex is going to be a thing forever. And I mentioned this before. There's a lot of things going on in the monetary system globally. And I know some of you guys that are, brand new in this industry and you're running around trying to be influencers and you think you know everything. I promise you this, in your lifetime, maybe inside the next 10 years or less, Forex is not going to be a thing. And I'm telling you, I've said this before in Twitter spaces. I've said this to my private students in mentorship. I'm trying to show you another way. So that way, when it does in fact happen, when they do away with and make it outlawed that you trade these other currencies. We used to have the Deutschmark futures contract. That currency still exists, but you can't trade it anymore. Just like a pork belly, you can't trade it anymore. But you're all eating bacon, right? Okay, that's where bacon comes from. Pork bellies. Those pork belly futures, they don't trade anymore. Egg futures don't trade anymore. So if you're paying attention, you're seeing all these central bank digital currencies being discussed, and we've been talking about this before anybody else was seeing it. I've been warning you about it. That's why I've been telling you crypto is not the thing. Okay, your beloved Bitcoin ain't going to be here forever. Okay, I'm telling you, it will not be here. I know you want to argue with me, but I've made so much money, and you're an old man, ICT. You don't know what's going on. I know more than you realize, and I'm trying to be very, very polite in the way I'm doing this. But you're all going to get wrecked doing that. When they institute real central bank digital currencies, you will have a time limit on when and how you spend your money. And you will not be able to escape it by trading or investing or operating with Bitcoin. If Bitcoin was the escape from fiat currency, then they wouldn't be able to lock your shit down, take your money, keep you from being able to spend it. Where's the protection in it? There ain't none. As soon as they put a futures contract on it, guess what? I told everybody, it's done. It's over. The illusion is over. Our government put that together. Satoshi is a myth. Period. Okay? That's the way it is. And you have to make preparations, folks. You have to make preparations for a market environment that is outside of just Forex and crypto. Stocks are going to be around. There's always going to be company issues and shares. That's going to be there. Okay. If you're outside the States and you can't trade our futures contract, that's okay. You can trade whatever your stock market is. My stuff works there. Okay. It works there just like it works here. And you just have to make sure that you have opportunities outside of what you think with a very myopic view that you can only make your money through Forex. You can only make your money through crypto. Things are about to get really, really difficult, extremely difficult. And having lots of money like I do does not have an exemption for me. I'm going to feel it just like you. Having lots of money is not an exemption to what's coming. When they change things on the financial front and they put an expiration on how long you can have your money before it expires, and yes, it's a real thing. That's why these things are concerning, but you're not going to stop it. You're not going to stop it. You can come up with all these little crypto coins and all these little things, okay? But that is another distraction to the inevitable, which is eventually everything's going to go to one currency. You're going to see it in your lifetime. That's the reality. And as far-fetched as you think that may be in science fiction level nonsense, and I'm sure some of you are laughing right now, especially you 20-year-olds, that know everything. Watch and see. Watch and see exactly what I've been saying is going to happen. I'm batting 1,000, folks. Okay, I'm not just a precise person on these lower time frames and on the daily charts when we're doing high time frame macro analysis. I'm telling you the future before it happens. And I've been trying my best to do it in a manner where it doesn't scare you into paralysis, because there's lots of opportunities now and then. But once it's here, I don't have any answers for you. I don't have any answers for myself. I don't know how it's going to be once it really fully happens, but it's going to happen abruptly. It's going to happen so fast, so shockingly, and it's going to come through pain, because people are going to be wanting some kind of resolution or protection or an ulterior means of doing things so that thing never happens again. Crash. So you have to open your eyes to opportunities that exist out of what you're already trading right now. You have to be outside of that. You can't just simply say, well, this is going to always work because ICT says every week, every day, and it won't stop. There is a time when it will. When they fundamentally change how we can trade and speculate, and I believe I'll see that in my lifetime. And I'm 51 now. Does that mean we won't be able to trade? Well, I think there's going to be a whole lot of restrictions on who's allowed to trade, who can buy and sell. And I'll leave that for a SoundCloud discussion. Let me drop into a 60-minute chart real quick. All right, so we have nice little fair value gap in here, trade up into that. We're in sell side now. So you want to have 108.33.8 on your chart at sell side. So I would expect that to be delivered today. So there you go. You do what you want to do with that. I'm not saying you should trade it. We're digging up above that high here. We're looking for that for the last few weeks now. And I just don't know how we're going to engage this high, if at all. GBP, USD. I haven't seen her for a while. We're still inside that daily. Let me see. Yep, they're inside that inefficiency. Relative equal lows, and then we have this one here. So there's lots of sell side resting below there. I'd like to see, assuming that we maintain this bullishness on the dollar, just be careful because it's Friday. But longer term, I think we may want to go below here and then attack the sell side right in here. But this type of price action as a forex trader, there's better markets to trade, man. I mean, just look at what we've been doing in the NASDAQ and the S&P. There's no comparison. There's literally no comparison. And then when you look at stuff like this here, he's putting a Bitcoin chart up. Oh, crap. ICT's got Bitcoin on. is that? Let me expand this up. Okay, sell side resides here on Bitcoin, and we've had multiple approaches to try to go higher after taking buy side here. If you recall, remember I said I was going to do Bitcoin? I'm not going to talk about Bitcoin. I think that was a weekly inefficiency. Let me pull up the weekly chart. Yeah, right up here, that was like the worst case scenario, if it went up to that point here, but this is what I was looking for. And we basically did that. And there's sell side here, and there's a little bit of inefficiency. Now, here's the key to your Bitcoin. If we overlap all of this and dig below the consequent encroachment of that candle right there, this sell side is going to be roasted. And before the elections of next year, this right here is going to be taken out. There you go. That's what I'm telling you. Okay, so your Bitcoin 100,000, you can put that to bed. That's not happening. Okay, I promise you that's not happening. Okay, I promise you, I promise you, I promise you, your Bitcoin 100,000 ain't gonna happen. Okay, it's not happening. So, is there anything else? Gold. I know some of you are probably thinking, please ICT, pick up on my wavelength right now. Talk about gold. All right. I use forex.com whenever I'm looking at things like this. I drew your attention to on the weekly, on the daily chart. I think the last time we talked, I was looking at this area down in here. We're digging into the sell side there. As long as this keeps dropping, we'll be looking for sell side here and higher prices on the dollar. That's how you want to judge it. Okay, so if you're a gold trader, you really want to be watching the dollar index. They're going to be inversely correlated. So as one goes up, the other should go down. So you're constantly balancing that out over and over and over again. And right now, because it's Friday, because we're in sell side, we're below an old key low on the daily chart, you have to be very, very careful. No new positions should be assumed in gold going short with a large degree of risk. That's basically what I'm saying. It doesn't mean you can't short it. It just means that you don't want to be doing it with heavy leverage, because time of the week, which is the end of the week, it's Friday. They could be using Friday to establish some weekend sentiment to get people wanting to do something going into next week. So they'll be anticipating all through Saturday and Sunday before the markets open again, a willingness to want to do something, and it's engineering sentiment. So that's why it's very, very important that you understand day of week phenomenon that I try to teach in my lectures, because knowing that can help you not assume risk foolishly going into the weekend or getting tricked by what they do on a Friday, because they can do sometimes many things on a Friday that may think, oh, it's going to be going higher next week, and then all of a sudden they gap it lower on Sunday and then just completely destroy everybody and their sentiment and break hearts. Real quick, we'll pass through on, you can tell I love this, don't you? ICT's never going anywhere. He's going to be here. No, I'm not. Maybe on YouTube once a week I'll give you a review or something, but Twitter and all that business, it's not going to happen. All right, so we're digging into that inefficiency again here. Here we are here. And we don't, here's what we don't want to see. We do not want to see, because it's Friday, we don't want to see this traded above and treated as support. If it does, whatever low's in place, that's probably going to be the low for the day, because it's Friday, and that's what I would expect. I'm not trading today. Okay, I want you to understand that. I'm not going to be putting trades on, so that way you get a dose on Twitter from me. I'm not going to give you any screenshots of here's what I did. I'm going to be away from the charts. Do not do anything without any experience, without any kind of knowledge about what it is you're trying to do or what you should or shouldn't do. Don't risk today. We've already moved so far this week already. The chances of a TGIF, which is thank God it's Friday scenario, where it pulls back up into 20 or 30% of the weekly range. That means pull up a weekly chart and from the highest high of the week to wherever the lowest low is that's formed, as we go into the latter portions of the afternoon today, we could see it trade back up into the 20 to 30% of that range. That's TGIF. We're not trying to predict a closing price, but it's always likely to occur, especially if we had, a lot of movement. And we've seen a lot of movement on the sell side of this market this week on indices. Old bones cracking. ESU. All right, and here's the one you want to be watching for S&P. Okay, so that's this level here. Remember I said I wanted to see that area stay open? Thank you so much. Small little fair value gap there. Boom. Just watch and see if we do in fact dig down into here. Like I said, that would be enough for me. Like if I was short today, or if I was short from yesterday, which I'm not, I don't have any open positions right now. I would be content with getting out one tick above this level. So 43, 49, that would be a limit order where I would be done, and I would be content with it. I don't give a shit if this thing went down to 4,200. That's the way I would trade it, because it's Friday, it's already moved a lot, and there's no hope for anyone that tries to put their entire career on the result of one trade. And I teach this in my lectures and my Twitter spaces. You really want to try to avoid doing that. Don't put all your hopes and dreams in the make it or break it. The success or failure is measured only on the basis of whatever that trade is you're doing today. And the way you prevent that from happening is not over leveraging, not trying to do more than you should, and or look for home runs. In my mind, I would be content with the weekly range being complete once it trades into this area here. And I would not require it to trade into the midpoint of it or to the low of it or through. I don't need that. You don't need it either. So it would be fruitful for you to simply tape read the rest of the day. If you made money this week, be happy with that. There's no need for you to make more of it today. If you think that, or someone on social media is telling you that you should, you are a fool. You're being manipulated and influenced by other people. That means you're not driving this ship. You're not the captain of your ship. You're not the CEO of your company. You're letting other people run it. So, anyway, I'm not sure if you got anything out of all this today, but there it is. And I want you to enjoy this weekend. Like I said, if I don't do the review tonight, I will do it tomorrow sometime before 1 o'clock. And then I'll have a lecture for you on Sunday, something in terms of teaching. And with that, I'm going to close it. Have a good weekend.